I had to scratch my head a bunch of times and I was like, where is this guy getting all this liquidity? Because he was like buying 9% of Robinhood. He was putting like $1 billion into this. He was donating to all these politicians. And I was like, it did not make sense to me where he was getting all this cash.
No one can protect a bad player, to be very frank. If a guy is very good at lying and is very good at just pretending to be what he's not.
In today's video, CEO of CoinBase, Brian Armstrong, opens the can of worms of the underdealing and events that preceded the crash and exposure of FTX and its founder, Sam Bankman-Fried. This episode promises to be revealing, so click that subscribe button now so you don't miss any update, as we should be keeping you updated on every development.
After that, we need to kind of think about how we go forward as an industry here and both take a long-term perspective, make sure the good companies in the space aren't allowing one or two bad actors to kind of mess it up for everybody else. And it feeds into the whole regulatory story too, because companies like Coinbase are already regulated, but we're regulated like a traditional financial service business. But we don't have clarity about the crypto specific regulations, like what's a commodity, what's a security. And that lack of regulatory clarity, I believe, has pushed a lot of this business offshore to these less regulated exchanges. That's part of what caused the blow up today. They were based in the Bahamas, and there's not sophisticated financial regulators overseeing what they were doing. This was all going down. I mean, I spoke to Sam about, he was trying to raise emergency financing and things like that. And I spoke to CZ about why he was considering buying the asset. I thought it was a bad idea. But my understanding of what happened at this point, and again, I don't have all the facts. This is just my understanding, is that, FTX was in a position where they had this market maker, Alameda, that was investing in risky things. And that's fine. Like market makers, hedge funds, they're designed to take more risk. It appears at this point that back during the last shakeup in the crypto industry where, Terra Luna and Voyager and Celsius and Three Arrows went under, it appears that Alameda took a big loss at that time as well. They may have even been underwater. And instead of just saying, hey, this hedge fund's going to blow up too, which would have been unfortunate. People would, Sam would have lost money. It's embarrassing, but it's not illegal for a hedge fund to blow up. It happens with some regularity. Instead of just letting it blow up, it seems like at this point, he took customer funds. So it seems they had this solvency issue. And instead of just letting it blow up, Sam basically said, hey, we have a bunch of customer assets over here at FTX, or he somehow basically made a loan from FTX into Alameda to try to prop it up. I don't know why he did that. I mean, that's the moment in my mind where he crossed the line into probably committing fraud. And I think he probably lied to users, lied to investors, and he went around and tried to bail out these different companies like Voyager and BlockFi and to sort of prop up this thing. And maybe he thought he could trade his way out of it or something. I'm not sure, but that seems to be where the mistake was made.
Many cryptocurrency exchanges and businesses are based in countries with lax or zero regulations of the cryptocurrency industry. FTX was based in the Bahamas, which Brian mentioned to point out that the United States government had little influence on the company. What the U.S. government could do was provide regulations that protect investors within the country. The subject of regulation has continued to be the most important discussion since the exposure of schemes and illegalities of FTX founder Bankman-Fried, who ran the exchange like his personal business, using investors' and traders' money as he pleased, because the industry was not under regulation. But were there no red flags that this could happen? Brian says there were.
I did not see this coming. Like he appeared to me to be a very bright, credible, competent person. Perhaps a bit young, perhaps, a bit reckless at times, but not unethical and not committing fraud. I definitely did not see that. If I look back to see, were there any warning signs that I should have thought twice about it? One of the things I noticed was that in 2021, Coinbase had a good year. We did $7 billion in revenue, $4 billion of positive EBITDA. We became public as a company. At that time, FTX did about $1 billion in revenue. And I knew how much money we had for our venture budget and just like different investments we wanted to make. And I knew their revenue. And I had to scratch my head a bunch of times. And I was like, where is this guy getting all this liquidity? Because he was like buying 9% of Robinhood. He was putting like $1 billion into this. He was donating to all these politicians. And I was like, it did not make sense to me where he was getting all this cash. People just kept telling me, oh, his market maker Alameda is just printing cash. And I was like, okay, I guess it seems like a conflict of interest to own an exchange and a market maker. That's why we haven't done it, but more power to him, I guess. And so I was surprised. I didn't speak up. I can't explain the psychology of it at this point, whether he's a pathological liar or if he's started off good and somehow under the pressure of this whole thing went bad. But the minute you can go watch the interviews, he's lying to people about why he's bailing out Voyager and BlockFi and he knew at that time that most likely he knew at that time that they were not solvent. Alameda was not solvent, and so that's where he crossed a major line in my book.
Brian reveals he had suspicions when Sam Bankman-Fried went on a spending spree, purchasing companies and spending heavily on politicians. The 30-year-old CEO of FTX holds the record as the second highest funder for the Democratic Party in the last year. He spent a total of $39.8 million on the party, even outspending billionaires such as Michael Bloomberg, who had committed $28.3 million. Bankman-Fried's motivation was to Capitol Hill for favorable crypto regulations. We would most likely be getting very stiff regulations from the House following this scandal of fraudulent mismanagement of the customers' funds by Bankman-Fried. That wasn't all. SBF had also invested a lot of money in various companies and firms. Many venture capital firms also invested in SBF and FTX, the most prominent being Sequoia Capital, which had an investment of $214 million in FTX, now worth $0. The VC initially had much praise for the young entrepreneur, believing he was likely to be the world's first trillionaire. All positions on the praises and endorsement of Bankman-Fried are now rescinded. Brian reveals that he also had respect for SBF, thinking he was an exceptional entrepreneur. How SBF was able to fool everyone for so long has continued to be a mystery.
If you're a regulated financial service business, but you're not a bank, we're regulated as a trust company, a money transmitter, etc. You're required to hold customer assets one for one. If you say the customer has one Bitcoin, you have to hold one Bitcoin. If they say they have $100, you have to hold $100. And so that's the case with CoinBase. You don't have to take our word for it, by the way. You can look at our audited public financial statements as a public company with an independent, Big Four accounting firm who went to go verify all of that. And that's what various custodians and exchanges, that's what they all should be doing. By the way, if you're regulated as a bank, you can actually go invest some of those, but there's very strict regulation around that and capital requirements and whatnot. And we're not a bank. So we hold one-to-one. Now, if you're an investment fund or a hedge fund or something like that, then you can try to take positions in different coins and different assets, and they could go up and they could go down. You may lose your investors' money, but there's no such thing as the customer assets being involved in that. There needs to be clear segregation of those customer funds and from what an investment fund would be or corporate funds. And that's where they got in trouble. They basically commingled customer funds with their hedge fund.
FTX has practically declared itself insolvent after filing for bankruptcy. The exchange had about 130 other businesses and subsidiaries linked to it, and they are all included in this bankruptcy filing. The exchange has declared a liability of $10 billion, money it should have held in trust, and now unable to recoup to investors and customers. This is raising another question of how to properly classify cryptocurrency exchanges. What are they really? Brian says exchanges are supposed to operate as trust funds, and should always be able to provide the assets given to them for holding. There would be more to this story, so subscribe to the channel now, so you don't miss it. Also, give this video a thumbs up to show you're following the development.